Welcome to the deep dive, where we like to, really unpack these complex topics. We try to extract those golden nuggets of
Yeah.
knowledge. And today we are diving into the world of personal finance, but we're going to be looking at it through the lens of The Psychology of Money by Morgan Housel.
Great book.
And, it's not your typical finance guide.
Right.
There's no, complicated formulas in it or market predictions.
Yeah.
It's really more a collection of insightful stories
Mm-hmm.
that reveal the psychological factors that drive our financial decisions, which a lot of times are overlooked.
Absolutely. Yeah.
So we're going to be exploring these key concepts like saving, risk, and wealth building.
Yeah.
And I think summarizing each chapter's main lessons is going to be a good way to go because we want to make these financial insights accessible and relatable to everyone.
Sure.
So let's get started.
All right.
The book kicks off with this really powerful premise.
Yeah.
Financial success is not solely determined by your IQ or technical expertise.
Right.
It's much more about understanding your relationship with money and making, sound behavioral choices, even when emotions run high.
Even when things are crazy. Yeah.
Yeah. Like Hal also shares this story about this brilliant tech millionaire.
Oh, yeah.
Made a fortune,
Yeah.
but lost it all because of poor financial decisions.
Yeah.
So he was a genius in his field,
Totally.
but he lacked the emotional intelligence to manage his wealth effectively.
I think we all know somebody like that.
I know, right?
Yeah.
So this underscores the importance of self-awareness
Right.
and recognizing our own biases
Absolutely. Yeah.
when it comes to money.
Huge.
We might be prone to overconfidence or impulsivity.
Right.
Or maybe we're overly risk averse because of past experiences.
Yeah. You get burned once and,
Yeah, exactly. And understanding those tendencies is it's crucial for making sound financial choices.
yeah. Like knowing yourself is a big piece of it.
Huge. So how do our personal histories shape our financial perspectives?
Yeah, this is fascinating. Housel argues that our upbringing, cultural background, and personal experiences all profoundly influence our views on money.
Okay.
And he uses a really interesting example. He contrasts the perspectives of Bill Gross, who's a renowned bond investor, and his father.
Okay.
So Gross saw bonds as a path to wealth, but his father, shaped by his experience with inflation, viewed them as potential wealth destroyers.
It's so fascinating how two people can look at the same financial instrument and have completely different interpretations based on their personal narratives.
Yeah, it's all about what they've seen and what they've been through.
Totally.
Totally.
And his principle applies to all of us.
Right.
Our financial decisions are always rational to us in the moment because they're aligning with our personal experiences and beliefs.
That makes sense.
Right. Someone who grew up during a recession might be more cautious with investments,
Mm-hmm.
while someone who experienced a booming economy might be more comfortable with risk.
Right. Makes perfect sense. Yeah.
That's a really important point to consider because it means that there's no one-size-fits-all approach to personal finance.
For sure.
What works for one person might not work for another, and that's okay.
Yeah, totally okay. You got to do you. You got to
Yeah.
figure out what works best for you.
Yeah.
And I think that's a key takeaway here.
Yeah.
You got to understand your own financial psychology
Mhm.
and then make choices that are in line with, your own circumstances and goals.
Right. Okay, so another crucial concept Housel explores is this role of luck and risk in financial outcomes.
Oh, yeah, it's a biggie.
And he tells the story of Bill Gates
Oh, yeah.
and his friend, Ken Evans,
Right.
both brilliant students with promising futures.
Yeah.
Gates obviously went on to become a tech titan.
Right.
Evans tragically died in a climbing accident.
Yeah.
And it's just this stark reminder that sometimes success is just influenced by factors beyond our control.
Totally. That's the thing with luck.
Right.
We don't always acknowledge it as much as we should.
Right. So it's often really difficult to separate skill from luck when we're evaluating financial outcomes.
Oh, totally.
Because we tend to overestimate the role of skill and underestimate the influence of chance.
Oh, yeah. We like to think we're in control more than we are.
Totally. So how do
Yeah.
we navigate this uncertainty and make informed decisions without, falling into that trap of thinking that we can perfectly predict or control outcomes?
Right. Well, Hassel suggests that we, acknowledge the role of luck,
Okay.
both good and bad, and avoiding that temptation to just blindly follow other people's strategies,
Yeah.
assuming that their success is solely down to their skill.
Right.
I mean, because, Could be other factors, right?
Yeah.
So instead, we should focus on developing a sound financial plan
Okay.
that incorporates like a margin of safety, recognizing that unexpected events can and do happen.
Yeah. Okay, so this leads us to like one of the most powerful concepts in the book,
Let's hear it.
the magic of long-term compounding.
Yes. Love it.
And Housel brilliantly illustrates this principle through, probably the greatest investor of all time, Warren Buffett.
The Oracle of Omaha.
Right. So Buffett's immense wealth wasn't accumulated through, risky bets or get-rich-quick schemes.
Yep.
It came from patiently and consistently investing for decades, allowing his returns to compound over time.
Just letting it do its thing.
Yeah, it's like planting a small seed,
Right.
watching it grow into like a mighty oak tree over time.
Just give it time. Give it time.
Yeah,
And it's those small actions repeated consistently.
exactly.
Over time.
So the key takeaways here are patience, consistency, and a long-term perspective.
Absolutely.
Even small amounts invested regularly
Yeah.
can grow exponentially over time, thanks to the power of compounding.
It's amazing, right?
It's incredible.
Yeah.
And it's encouraging, especially for those just starting out.
Oh, for sure.
It highlights that you don't need to have a huge sum of money
Right.
to start building wealth.
You can start small.
What matters is developing a consistent habit
Yeah. Yeah.
of saving and investing,
Absolutely.
even if it's a small amount every month.
Exactly. And the earlier you start, the better, because that's more time for that compounding to happen.
Right. So Housel also contrasts Buffett's approach with Jim Simons, a hedge fund manager known for his really high returns.
Yeah, super high returns.
But they were shorter lived.
Yeah.
So even though Simons' annual returns were way higher than Buffett's,
Yeah.
Buffett still ended up way wealthier because of the longer time frame he invested for.
Longer game.
Yeah. And this emphasizes that it's not just about like how high your returns are.
Right.
It's about how long you can sustain them.
It's about longevity, baby.
Yes. It's like the story of Jesse Livermore, legendary trader who made a fortune during the 1929 market crash,
Oh, yeah.
but later lost everything due to risky bets,
Yeah.
excessive leverage.
Yeah.
So his story serves as this cautionary tale, highlighting the importance of, patience, emotional resilience,
Mhm.
and sticking to a sound investment plan, even when there's market turmoil.
Yeah, even when things are going crazy, you gotta stick to the plan.
So Livermore's experience kind of underscores the need for discipline, that
Yeah.
long-term perspective.
Yeah. It's not about like timing the market perfectly or taking huge risks.
Right.
It's about consistently investing in like quality assets and just riding out those market ups and downs.
Right, because they're inevitable.
Oh, yeah, totally.
It's a valuable lesson, especially in today's market. I mean,
my gosh, yeah.
it's so volatile.
It's a roller coaster.
It's so easy to get caught up in the hype, make some emotional decisions, but having a well-defined plan
Yeah,
can really help you stay the course,
totally.
achieve those goals.
Absolutely.
So let's shift gears a bit and delve into Housel's perspective on the ultimate reward of wealth.
Okay.
He argues it's not about accumulating piles of money.
Right.
It's about gaining freedom and flexibility.
Yes, love that.
So it's about having that financial security to make choices
Yeah.
that align with your values, your priorities.
Yeah, and having options, right?
Yeah.
You can spend more time with people you love. You can pursue passion projects. You can, just have that peace of mind.
Yeah, that's security.
And that security.
Yeah.
So Housel even shares his personal story of like choosing a career path that gave him more freedom,
Mm-hmm.
even though it might not have been the path to like the highest possible income.
Right. And I could definitely relate to that. I mean, for me, having the flexibility to choose the projects that I'm passionate about and spending time with my loved ones,
It's priceless.
yeah, it's invaluable.
Yeah.
It's about creating a life that feels fulfilling and aligned with your definition of success.
Yeah, and that might not always be tied to, the biggest paycheck.
Right.
Yeah.
Exactly. It's about recognizing that, like, experiences and relationships
Yeah.
often provide more lasting happiness
Way more.
than, like, just material possessions.
Way more.
Yeah. Okay, so moving on to another aspect of building wealth.
Yeah.
Housel introduces this really compelling analogy.
Okay.
He compares saving money to energy efficiency for your finances.
Oh, I like that.
So he explains how reducing your financial needs through mindful spending
Yeah.
can be just as effective as increasing your income when it comes to building wealth.
Right. So it's not always about earning more.
Right.
It's about needing less.
It's not always about earning more, it's about needing less.
I love that.
Exactly.
Yeah.
It's about finding that balance
Right.
between, enjoying life and making conscious choices about where your money goes.
Yeah, because if you reduce your unnecessary expenses and you live below your means, that frees up more resources
Exactly.
to save and
It's a
invest.
powerful shift
Yeah,
in perspective
totally.
because instead of, constantly focusing on how to increase our income, we can look at like how to optimize our spending and make our money work harder.
Work smarter, not harder, right?
Exactly. So it's about being mindful of our financial habits
Mm-hmm.
and making intentional choices.
Absolutely.
And it's about, supporting our long-term goals.
It's about being intentional with our money.
Yeah. And this leads us to this other insightful concept
Okay.
Housel presents. The idea of being reasonable over rational.
Reasonable over rational, yeah.
So he acknowledges that we're not always perfectly rational beings.
Especially when it comes to money.
Right.
Yeah.
Our emotions can really influence those decisions,
Oh, yeah.
even when we think we're being logical.
Big time.
It's like that feeling of panic when the stock market drops.
Oh, yeah.
Rationally, we know markets fluctuate
Right.
and it's likely to recover,
Yeah.
but our emotions just take over. And
Yeah.
they lead us to making these, impulsive decisions, like selling our investments at a loss.
Yeah. You just want to get out.
Yeah, you're like,
Cut your losses.
yeah. So Housel argues that instead of, striving for this perfect rationality,
Which is pretty much impossible.
right, it's unattainable.
Yeah.
We should aim to be reasonably good with money.
Yeah, that's a good goal.
So that means recognizing our emotional biases,
Right.
but not letting them totally dictate our choices.
Not letting them run the show. Yeah.
Right. So it's about finding a balance
Balance. That's key.
between our rational
Yeah.
and our emotional selves.
Yeah.
And making decisions that feel right for us,
Yeah.
even if they're not perfectly aligned with economic theory.
It's not always about being a robot and following the numbers perfectly.
Right.
Sometimes you got to go with your gut.
And Housel actually shares this story of Julius Wagner-Jauregg,
Oh, yeah.
a Nobel Prize-winning doctor,
Wow.
developed this, unconventional and admittedly risky fever treatment for syphilis.
Really?
So his approach, it wasn't based on conventional wisdom, but it was reasonable.
Yeah.
And it ended up saving countless lives.
Wow.
So this story illustrates that sometimes the best financial decisions
Yeah.
might not be the most mathematically optimal, on paper,
Right.
but they can still lead to positive outcomes.
Yeah. Sometimes you got to think outside the box.
Totally. So it's a great example of how embracing a more holistic, reasonable approach
Uh-huh.
can yield better results
Yeah. Than just sticking to the rigid rules.
than strictly adhering to those rigid financial rules.
Exactly.
So it's about considering both the financial and the emotional aspects of our decisions.
Yeah.
And finding strategies that allow us to, sleep well at night.
Peace of mind.
Yes. And that's so important because
Right.
sometimes the best financial decision is the one that just gives us that peace of mind,
Absolutely.
even if it means slightly lower returns.
Yep. Yep. It's about your overall well-being.
Right.
And that financial security is just one piece of the puzzle.
Yeah. Okay, so this leads us to another important concept House emphasizes.
Let's hear it.
Embracing room for error in our financial plans.
Okay.
And he draws this really interesting comparison
Yeah.
to successful blackjack card counters.
Okay.
So these are people that have a system
Yeah.
that gives them an edge,
Right?
but they always factor in the possibility of losing.
Yeah.
They recognize that no system is foolproof.
Right.
Even the best strategies can be undone
Yeah.
by those unpredictable events.
You never know what's going to happen.
And this is crucial for personal finance
Oh, yeah.
because unexpected expenses, job losses, market downturns
Yeah.
can derail those plans,
Yeah.
even the most carefully crafted ones.
Totally.
So Housel argues that having a margin of safety in our financial lives is essential
Oh, yeah.
for weathering those inevitable storms.
For sure.
And this could mean having an emergency fund,
Right.
maintaining low debt levels,
Yep.
investing in a diversified portfolio.
Absolutely.
It's about creating that buffer,
Yep.
that cushion between what we expect to happen and what could happen.
Yeah.
Gives us that resilience to bounce back from setbacks.
You got to be prepared for anything.
Right, exactly. So now, this brings us to a critical point Housel makes.
Okay.
The power of narratives in
Mhm.
shaping our financial decisions.
Oh, yeah. This is a big one.
So he explains how stories,
Right.
whether they're personal anecdotes, economic theories, news headlines,
Mm-hmm.
can profoundly influence our perceptions of risk and reward.
Totally, we're all about stories.
And we're all susceptible to these narratives, and these stories can lead us to making, irrational
Oh,
decisions,
yeah, for sure.
whether it's chasing those hot investment trends
Right?
or panicking during market downturns.
Yeah, FOMO is real.
It is. So he uses the example of Yahoo stock during the dot-com bubble.
Oh, yeah.
And it was interesting. He illustrates how investors with different time horizons perceived the value of the company differently.
Right. Some people were in it for the long haul. Others were just trying to make a quick buck.
Yeah, and some saw it as a long-term investment, while others just focus on, its short-term momentum,
Right.
leading to this disconnect between the company's perceived value
Yeah.
and its actual performance.
Right, because the hype was real.
And that disconnect,
Yeah.
fueled by those optimistic narratives
Yeah.
and the speculative fervor,
Yeah.
ultimately contributed to the bubble burst.
Oh, yeah.
Housel's point is, we need to be aware of how these narratives, often driven by emotions and speculation,
Right.
can distort our perceptions of risk and reward.
Totally. We got to be careful about getting caught up in the hype.
Right. So it's a powerful reminder to be critical thinkers, question assumptions, look beyond the hype when we're making these decisions.
Absolutely.
We need to evaluate investments based on sound principles and data,
Right.
rather than just getting swept away by captivating stories.
Yeah, do your research.
So it's about developing that healthy skepticism,
Yeah.
not blindly following the crowd.
Think for yourself.
And this brings us to the final concept we'll cover in this part of our deep dive.
Okay.
The importance of defining success on your own terms.
Ah, yes.
So Housel argues that, blindly following those societal expectations or trying to keep up with the Joneses
Oh, yeah.
can lead to financial misery,
It's a recipe for disaster.
because what constitutes success varies so widely from person to person.
Totally.
Trying to achieve somebody else's version of success is a recipe for disappointment.
Absolutely.
So it's about recognizing that everyone has different priorities, different values.
Right.
Some people might prioritize financial independence.
Right.
Others might value those experiences in travel,
Yep.
while others might focus on building a legacy for their families.
That's a good one.
And all of these goals are valid as long as they're authentic to you.
As long as it's what you want.
Right. So Housel encourages readers to reject that pressure, to conform to those external expectations, and to find their own financial goals based on their values and their aspirations.
That's the key.
So it's about creating a financial life that aligns with your personal definition of success, rather than trying to fit into someone else's mold.
You do you.
Yeah, exactly.
Figure out what matters to you.
And align those financial decisions with those priorities.
Exactly.
Welcome back to the Deep Dive. We're continuing our exploration of the psychology of money by Morgan Housel, still unpacking all those psychological factors that influence those financial decisions.
Yeah, those sneaky little things.
Right. So last time we discussed how our personal experiences, those narratives,
Yeah.
really shape our financial perspective.
Totally.
And now Housel's taking us on this fascinating journey. We're going to go through economic history and explore how these societal shifts and this kind of collective psychology has impacted these financial trends.
Oh, interesting.
So he starts by examining the post-World War II era, this period of significant economic transformation.
Okay, yeah.
So you've got millions of soldiers coming home. They're facing uncertainty, a potential economic downturn. There was a severe housing shortage. Wartime jobs are disappearing. And the world is grappling with this aftermath of this devastating conflict.
It was a crazy time.
Yeah. So it was this time of both immense potential and tremendous uncertainty.
Right, like a crossroads.
Yeah. And Housel highlights how America navigated this pivotal moment and emerged as this global economic powerhouse.
Yeah, it's pretty remarkable.
So he points to several key factors that contributed to this economic resurgence.
Okay, what were they?
So one crucial element was the government's decision to keep interest rates low,
Oh, okay.
even as inflation was spiking in the immediate post-war years.
Interesting.
This policy was aimed at stimulating borrowing and investment,
Okay.
really laying that foundation for the rise of the American consumer.
So make it easy to buy things, get the economy moving.
Exactly. So
Yeah.
those low interest rates made it easier for people to buy those homes, cars, appliances.
Oh, yeah. The classic American dream stuff.
Right. And it fueled this economic growth and created jobs.
Makes sense.
So another significant factor was the rise of consumer credit.
Ah, credit cards.
Yes. So those credit cards and installment plans, they allowed people to purchase those goods and services they couldn't immediately afford, so it further accelerated that consumer boom.
So it's like buy now, pay later, basically.
Yeah. So it's interesting how this period fostered this cultural acceptance of debt,
Right, as long as it wasn't, like, out of
as
control.
long as it was manageable and contributed to a rising standard of living.
So debt became, like, normal.
Yeah, and it became increasingly normalized
Mhm.
as this tool for achieving the American dream.
Okay, so what happened? Did this boom last?
No. So this era of shared prosperity started to shift in the 1970s. The recession of 73 marked a turning point with rising unemployment, persistent inflation, and, those climbing interest
Oh,
rates.
so things started going downhill.
Yeah. And this economic turmoil kind of coincided with like this growing social unrest, political upheaval.
Yeah, I remember learning about that in history class.
It was fueled by the Vietnam War,
Yeah.
civil rights protests, political
It was
assassinations.
a tumultuous time.
Yeah. It was this period of disillusionment and uncertainty. As that promise of post-war prosperity, it started to unravel.
So what went wrong?
Well, Housel argues that this unraveling stemmed from this fundamental disconnect between economic realities and those social expectations.
Okay, I'm following.
So while the economy continued to grow in the decades after the 70s, that growth became like increasingly uneven.
Okay.
There was a widening gap between the rich and the poor.
So the benefits weren't shared equally.
No. So those social expectations,
Yeah.
they were shaped by this kind of egalitarian spirit of the post-war era. They didn't keep pace with these changing economic realities.
People were hanging on to this idea of a, like, fair system.
Yeah, they were clinging to this idea of this broad middle class and this sense of shared prosperity.
Even though things were changing.
Even as income inequality increased,
Right.
social mobility declined.
It's like the American dream was becoming less attainable.
Right. And this disconnect fueled this simmering sense of frustration, resentment
Makes sense.
that manifested in various social and political movements.
Whoa, like what?
So Housel cites examples like the Tea Party, Occupy Wall Street, and Brexit as these manifestations of this collective outcry against the system that felt increasingly rigged.
Right, rigged against, like, everyday people.
Yeah. And these movements, despite their diverse ideologies and agendas,
Yeah.
they shared this common thread. It was this rejection of the status quo.
Mm-hmm.
And it was this yearning for a return to a time when those economic gains felt more broadly shared.
So they wanted to go back to, like, the good old days.
Yeah. And Housel's analysis of this period, it highlights this powerful influence of social narratives and expectations on economic behavior.
So it's like our beliefs about the economy can shape how it actually performs.
Right. So even when those economic realities shift, people often hold on to those outdated narratives and expectations,
Sure can cause problems.
leading to social and political unrest.
It's like we're living in the past.
Yeah. And it's a reminder that understanding, like the psychology of money, isn't just about mastering personal finance. It's about comprehending those collective forces that shape our economic landscape.
It's about the bigger picture.
Yeah. So let's transition back to those practical lessons and insights that Housel offers for navigating the world of personal finance.
Okay, back to the practical stuff.
So he begins by emphasizing the importance of leaving room for error in our financial plans.
Okay, yeah, that's always a good idea.
Yeah. And he uses this analogy of blackjack card counters,
Okay.
who, even with the system they know gives them an edge,
Yeah.
they always factor in the possibility of losing.
So they're not overconfident.
No. They recognize that no system is foolproof, and even the best strategies can be undone by those unpredictable events.
Right, because you never know what can happen.
And this is crucial for personal finance, where those unexpected expenses, job losses, market downturns, they can quickly derail even those most meticulously crafted plans.
Life throws curveballs.
Yeah. So Housel argues that having that margin of safety in our financial lives is essential for weathering those inevitable storms.
So we need a buffer.
Yeah. And that could mean having that emergency fund, maintaining low debt levels, investing in a diversified portfolio.
Spreading the risk.
Exactly. It's about creating that buffer between what we expect to happen and what could happen, giving us that resilience to bounce back from those setbacks.
So we're not totally wiped out if something goes wrong.
Exactly. So now let's revisit that power of compounding, which we touched upon earlier.
Yeah, compounding is awesome.
Yeah. So Housel reminds us that even small amounts of money invested consistently over long periods can grow exponentially.
Time is our friend.
He gives this example of someone who saved just $1 every month from 1900 to 2019
Okay.
and invested it in the stock market.
Wow, a long time.
Yeah. So despite market crashes, recessions, world wars, that $1 monthly investment would have grown to over $1 million by 2019.
That's incredible.
Yeah, and it's just this powerful illustration of how time is the greatest ally of the investor.
Patience pays off.
Yeah. So those key takeaways are starting early, investing consistently, and letting compounding work its magic.
Slow and steady wins the race.
Exactly. Now, Housel's also addresses the emotional side of investing,
Oh, yeah, that's a big one.
acknowledging that it's not always about cold rationality.
Right, we're human beings, not robots.
Right. So our emotions, they often influence those financial choices, even when we believe we're being logical.
Yeah, we can get caught up in the moment.
Yeah. And we might sell stocks out of panic during like a market drop, even though rationally we know that the market's likely to recover over time.
Right, it's that fear taking over.
Yeah. Or we might chase those hot investment trends, driven by that fear of missing out, despite those inherent risks.
FOMO strikes again.
Right. So Housel stresses the importance of recognizing those emotional biases and developing strategies to mitigate their influence.
So how do we do that?
Well, this could involve having a written investment plan, working with a financial advisor,
Okay.
or just simply taking a step back and letting those emotions cool down before making any major financial decisions.
Don't make decisions when you're emotional.
Exactly.
Yeah.
So he advocates for finding that balance between our rational and emotional selves, making those decisions that feel right for us,
Okay.
even if they're not perfectly aligned with economic theory.
It's about what works for you.
He uses his own decision to pay off his mortgage early, as an example.
Oh, interesting.
So he knew that keeping that mortgage and investing that extra money in the stock market would likely yield higher returns over the long term.
Right, that's what the numbers would say.
Right. But that peace of mind and that sense of security he gained from owning his home outright outweighed those potential gains.
So he prioritized peace of mind over potential profit.
Right. And it was this reasonable decision that aligned with his values, his priorities, even if it wasn't the most financially optimal move on paper.
Makes sense.
So this highlights a key takeaway from this book. Personal finance, it's about more than just maximizing returns. It's about creating a financial life that feels good and that supports your overall well-being.
Yeah, it's about the whole picture.
So Housel encourages readers to embrace that concept of reasonable over rational, making those choices that align with your values, risk tolerance, and your emotional well-being.
It's about finding that balance.
Right. So he stresses that this balance, it's crucial for long-term financial success
Okay.
and for just living a life that feels fulfilling.
It's about more than just money.
Right. Now, building on this idea of aligning your financial decisions with your values, Housel emphasizes the importance of defining the game you're playing.
The game you're playing. Okay.
So he argues that one of the biggest mistakes we make in personal finance is comparing ourselves to others who are playing a different game.
Oh, yeah. I've definitely been guilty of that.
We might feel inadequate because our investment returns aren't as high as our neighbors. Or we might make, those impulsive financial decisions trying to keep up with a lifestyle we see on social media.
The comparison trap.
Yes. But these comparisons are meaningless if we're not playing the same game.
Right, because everyone has different goals.
Someone aggressively investing for, early retirement might have a higher risk tolerance than someone who's prioritizing saving for their children's education.
Right, totally different situations.
So comparing their investment strategies or returns wouldn't make sense.
It's like comparing apples and oranges.
Exactly. So it's crucial to define your own financial goals, understand your own risk tolerance, and create a plan that aligns with your unique circumstances and aspirations.
Focus on your own game plan.
Exactly. And avoid getting distracted by what others are doing,
Don't worry about what other people are doing.
because their financial goals and strategies might be completely different from yours.
Stay in your own lane.
Right. This brings us to another concept Housel explores: the disproportionate impact of a few key events on our financial outcomes.
Okay, so like big moments that can change everything.
Yeah, so he introduces this concept of tails drive everything, explaining how a small number of those extreme events often account for the majority of results.
Interesting.
So, for instance, in the stock market,
Yeah.
just a handful of days with exceptional gains or losses
Okay.
can make or break an investor's returns over a decade.
Wow, so a few days can make all the difference.
Right. Similarly, in business, just a few blockbuster products can drive most of a company's profits.
So it's about those like outlier events.
Right. And this principle has significant implications for how we approach personal finance.
How so?
Because we need to be prepared for those unexpected events both positive and negative.
So we need to be adaptable.
Right. Embrace the inevitability of those setbacks.
Don't freak out when things go wrong.
And focus on building that resilience and adaptability into our financial plans.
So we can roll with the punches.
Exactly. This also means we shouldn't get overly fixated on, like, those short-term fluctuations or those individual investment decisions.
Yeah, it's the long game that matters.
Yeah. It's about focusing on the long game, recognizing that just a few key decisions and a bit of luck can have this outsized impact on our financial outcomes.
So we need to be strategic, but also lucky.
Right. So now let's circle back to that influence of narratives, which we discussed earlier.
Oh, yeah, the stories we tell ourselves.
Right. Housel argues that those stories, whether they're personal anecdotes, economic theories, or news headlines, they can significantly shape our perceptions of risk and reward.
We're influenced by what we hear and read.
Yes. We're all susceptible to these narratives, and they can lead us to make, irrational financial decisions.
So we need to be critical thinkers.
Exactly. And he uses the example of the dot-com bubble, where those optimistic narratives about the internet
Oh, yeah.
fueled that speculative frenzy and inflated those valuations.
Like a gold rush.
Yeah. So investors caught up in that hype, they ignored those traditional metrics of value and just poured money into companies with little to no earnings.
And it all came crashing down.
Right. When that bubble burst, many investors were left with worthless stocks.
Ouch.
So House's point is, we need to be aware of how narratives can distort our perceptions and be critical thinkers when making financial decisions.
Don't believe everything you hear.
Exactly. It's about looking beyond that hype, questioning those assumptions, and evaluating investments based on sound principles and data.
So do your research. Think for yourself.
Now, bringing it all together, Housel emphasizes the importance of defining success on your own terms.
Yeah, that's so important, right?
Right. So he argues that, like, blindly following those societal expectations or trying to keep up with the Joneses, it can lead to financial and emotional distress.
Yeah, you'll never be happy if you're always trying to keep up with other people.
Right. So what constitutes success? It varies widely from person to person. Trying to achieve somebody else's version of success, it's a recipe for disappointment.
You gotta define your own success.
Exactly. So some people might prioritize financial independence,
Okay.
others might value those experiences, the travel,
Yeah.
and others might focus on building a legacy for their families.
All good goals,
And all those goals are valid as long as they're authentic to you.
as long as it's what you truly want.
Right. So Housel encourages readers to reject those external pressures and define their own financial goals based on their values and aspirations.
It's about what matters to you.
It's about creating that financial life that aligns with your personal definition of success rather than trying to fit into a predefined mold.
It's your life, your money, your choices.
Exactly. True financial well-being, it comes from living a life that feels fulfilling and aligned with your goals, not from chasing those arbitrary benchmarks of wealth or status.
It's about finding what truly makes you happy.
Right. Now, this leads us to some practical tips Housel offers for achieving financial success and cultivating a healthy relationship with money.
Okay, let's hear it though.
So he emphasizes the importance of saving consistently, even if it's a small amount each month. Remember, time is the investor's greatest ally, and even those small contributions, compounded over time, can grow significantly.
Start small, stay consistent.
He also stresses managing risk, advising readers to avoid excessive debt, and diversify those investments to spread risk.
Don't put all your eggs in one basket.
Right. And he encourages readers to embrace this idea of enough, recognizing that more money doesn't necessarily equate to more happiness.
That's a tough one, but so true.
Right. Find contentment with what you have is crucial for avoiding that trap of constantly chasing wealth.
Be grateful for what you have.
Right. Now, while all these tips are valuable, perhaps the most important advice Housel offers is to be kind to yourself.
Be kind to yourself, okay?
Because personal finance, it can be a complex and emotional journey.
Oh, yeah.
And we're bound to make mistakes along the way.
We're all human.
Right. It's important to forgive yourself for those past financial missteps.
Okay.
Learn from them and focus on making better choices moving forward.
Don't dwell on the past.
So cultivate a positive and supportive relationship with money rather than viewing it as a source of stress or shame.
Money shouldn't be the enemy.
Right. And remember, personal finance is deeply personal.
Yeah, it's different for everyone.
Right. There's no one-size-fits-all approach.
So you got to find what works for you.
What works for one person might not work for another.
Exactly.
So Housel encourages readers to experiment, find what feels right, and create a financial plan that aligns with your values, your risk tolerance, and your overall life goals.
It's about finding your own path.
Right. So embrace that journey, recognizing that there's no finish line in personal finance.
It's a lifelong process.
It's a continuous process of learning, adapting, making those choices that support your evolving needs and aspirations.
So never stop learning and growing.
That's an insightful perspective.
Yeah.
It reminds us that personal finance, it's a lifelong journey, not a destination.
It's about the journey, not the destination.
It's about constantly learning, growing, refining our approach to money as our circumstances and priorities evolve.
Always evolving.
Okay, so as we wrap up our deep dive into the psychology of money, let's, kind of distill these key takeaways and really see how they can empower you on your financial journey.
Yeah, I think that's a great idea. There's so much good stuff in this book.
There is. One of the most powerful lessons, I think, is that financial success, it isn't just about mastering those numbers.
Right.
It's about understanding the psychology, those forces at play.
Yeah, all those things that are going on in our heads.
Right. So our emotions, our
Mhm.
biases, personal experiences, they all shape those financial decisions.
We're not always as rational as we think we are.
Totally. And we've seen how understanding those psychological factors can help us make those more informed choices. Whether it's recognizing our tendency to, maybe overspend a little bit,
Right.
or understanding how our upbringing might influence, our risk tolerance.
Like if we grew up during a recession, for example.
Exactly. So self-awareness is paramount.
Yeah, knowing yourself is key.
Another key takeaway, I think, is that importance of long-term thinking.
Oh, yeah, absolutely.
Compounding. It's a powerful force.
It's like magic.
And those small, consistent investments over time can yield those significant results.
Yeah, it's amazing what a little bit of money can grow into over time.
Totally. So it's about playing the long game and not getting caught up in those short-term market fluctuations or chasing, those get-rich-quick schemes.
Yeah, those never end well.
No, it's all about patience and consistency.
Slow and steady wins the race.
Exactly. Housel also emphasizes the need to define success on your own terms.
Yeah, you got to define what success means to you.
Right. Don't fall into that trap of comparing yourself to others or chasing those societal expectations.
Yeah, the comparison game is dangerous.
Because your financial goals, they should align with your values, your priorities.
It's your life, your money, your choices.
So whether it's financial independence, early retirement, or simply having the flexibility to pursue your passions, your definition of success is unique to you.
Yeah, there's no right or wrong answer.
Right. And remember, personal finance is a journey, not a destination.
It's about the journey, not the destination.
It's about continuous learning, adapting, and making those choices that support your evolving needs and aspirations.
Yeah, it's always changing.
Right. So Housel encourages us to be kind to ourselves throughout this journey. We're bound to make mistakes.
Yeah, we're all human.
Right. And the key is to learn from them and keep moving forward.
Don't dwell on the past.
So I think, as we conclude our deep dive into the psychology of money, I encourage you to really reflect on those insights that we've discussed.
Yeah, take some time to think about what resonated with you.
Consider how they might apply to your own, financial decisions, your relationship with money.
It's all about making those connections.
Think about your financial goals, your risk tolerance, and your definition of success.
What's important to you?
And remember, financial well-being, it isn't just about maximizing those returns. It's about creating that financial life that supports your overall happiness, your fulfillment.
Yeah, it's about living a good life.
So thank you for joining us on this journey into this fascinating world of the psychology of money. We hope you found this deep dive insightful and empowering. Until next time, keep learning, keep growing, and keep striving to create that financial life that aligns with your dreams and your aspirations.
And remember, be kind to yourself along the way.